Hey there, welcome to the Deep Dive. Today we're doing things a little differently, kind of like taking a trip to Jamaica. But not for the beaches or the reggae music, more like for insurance, specifically long-term insurance practices. We got our hands on this training manual, the kind they use for new insurance sales reps over in Jamaica, and we figured, why not unpack it? So if you've ever felt like intimidated by insurance, all the jargon and stuff, this deep dive is for you.
Yeah, it's like we're getting a sneak peek into insurance school, right? A crash course in everything you need to know.
Exactly. And believe me, it's way more interesting than it sounds. By the end of this, you'll be fluid in insurance. You'll know the different types of policies. You might even impress your financial advisor. Who knows?
Sounds like a plan. So where do we even begin with this?
Well, this manual, it starts off with the fundamentals, right? And that's risk. I know, sounds a bit dry. But trust me, it gets pretty interesting. Because insurance is all about protecting yourself from the unexpected.
Right. And the manual really dives into, the different types of risk. Pure risk versus speculative risk. And insurance mainly deals with pure risks, the kind where there's no chance of winning, only the possibility of something bad happening.
Okay, so give me an example of a pure risk, something that would keep me up at night.
Let's see. Imagine your house, catching fire. That's a pure risk. There's no upside, only potential for loss.
Oh, yikes. Okay, that makes sense. So insurance basically helps us prepare for those worst case scenarios, right? But what about things like investing in the stock market? You could win big or lose everything.
Exactly. That's what they call a speculative risk. There's a chance for gain, but also a chance for loss. Insurance usually doesn't cover those kinds of risks.
So insurance companies are what, the superheroes of pure risk then?
Yeah.
But are all pure risks, insurable?
That's a great question. And our manual, it actually lays out 4 conditions for a risk to be insurable. First, the loss has to happen by chance. It can't be something you intentionally cause.
Yeah, that makes sense. You can't just decide to burn your house down and expect insurance to pay for it.
Exactly. Second condition, the loss has to be definite, measurable. Insurers need to be able to put a dollar amount on the damage.
So a cracked phone screen wouldn't be covered.
Yeah.
Because the cost of fixing it's pretty small.
You got it. The administrative costs of dealing with that claim would be way more than the actual damage. The third thing is the loss has to be, significant enough. Significant enough to warrant insurance.
Otherwise, everyone would be filing claims for every little thing, and the whole system would, fall apart.
Right, exactly. And finally, the loss has to be predictable. Insurers use things like mortality tables to estimate how likely certain events are, death at different ages. That's how they figure out how much to charge for premiums.
Hold on, death. That's getting a bit morbid, isn't it?
I know, but think about it. We know death is going to happen eventually, but we don't know when, right? That uncertainty, that's what makes it insurable. Insurance companies can use data to kind of predict death rates and then, calculate how much to charge in premiums to cover the risk.
Okay, yeah, I see. So it's not just about the event itself, but the uncertainty of when it might happen?
Precisely. And speaking of premiums, did you know that insurance companies, they actually have a system to classify risks, which directly impacts how much you pay?
Oh, is that why some people have higher insurance rates than others?
You got it. They categorize people as standard risks, substandard risk, or preferred risk. It's almost like a grading system for how likely you are to file a claim.
So someone who, say, smokes, they might be considered a higher risk than a non-smoker and have to pay higher premiums.
You're catching on quick. And some companies, they even get more specific. They offer lower rates to preferred risks who exercise regularly or something.
Wow, so being healthy can actually save you money on insurance. That's a good incentive to take care of yourself. It's like a giant puzzle, right? Where your lifestyle choices and age and health, they all factor into your insurance rate.
That's a great way to put it. We're starting to see how all the pieces fit together.
I know, right? This is already making me feel more, informed about how insurance works. It's not just some random number they throw at you. There's actually a logic behind it.
Yeah, it's a whole system for sure. But let's shift gears a bit. Talk about why someone would even need life insurance in the first place. It's not exactly, the most exciting topic.
Yeah, it can feel kind of heavy. But this manual, it stresses that life insurance. It's all about providing financial security, peace of mind for your loved ones.
Yeah.
Especially if something were to happen to you.
It's like creating a safety net for your family's future. And the manual, it breaks down some very specific needs. that life insurance can address.
Okay, so like what?
Well, for starters, there's final expenses. Things like funeral costs, outstanding debts. Life insurance can help cover those immediate costs, so your family isn't burdened, right away.
That makes sense. It's definitely not something you want your loved ones to deal with
Yeah,
during an already difficult time.
exactly. And then there's the issue of replacing lost income. If you're, let's say, the primary earner in your family, your death could create a significant financial gap. Life insurance can help fill that gap, right? Ensure your family can maintain their standard of living. Cover those essential expenses like housing, food, education.
Speaking of education, the manual also mentions using life insurance to fund your children's education. I hadn't really thought about that before.
Yeah, it's a powerful tool for parents who want to, guarantee their children's future. No matter what happens, even if you're not around, your plans for their education, they can still be realized.
It's like an investment in their future that you can make today. What other needs does the manual talk about?
Oh, it's a pretty comprehensive list. There's supplement and retirement income, especially if you haven't saved as much as you'd like. Life insurance can provide that extra source of funds during your retirement years.
Interesting. So it's not just about protecting your family if you pass away, but it can also be a tool for your own financial planning long term.
Absolutely. And it can also help, let's see, pay off a mortgage so your family can stay in their home, cover estate duties, inheritance taxes, even protect businesses from financial losses, if a key person or a partner dies.
Wow, it really does cover a lot of bases. It's less about like doom and gloom and more about taking proactive steps to protect the people you care about.
You got it. And you know what else the manual highlights? The emotional benefits. Reducing worry, enabling confident planning, that overarching sense of peace of mind. It's not just about the money, right?
Yeah.
It's about knowing you've taken steps to care for your loved ones.
That makes a lot of sense. It's like having a backup plan for life's uncertainties, knowing that even if the unexpected happens, your loved ones, they'll be okay.
Exactly. So now that we've explored the why of life insurance, are you ready to dive into the different types available?
Let's do it. I'm ready to get into the nitty-gritty.
All right, buckle up. This is where it can get a little confusing. But the manual, it lays out the options pretty clearly. It starts by distinguishing between two main categories: whole life insurance and term insurance.
Okay, I've heard those terms before, but I'm not sure I fully get the difference. Can you break it down for me?
Sure. Whole life insurance, like the name suggests. It's designed to provide permanent coverage. You pay premiums for your entire life, and the policy builds cash value over time, almost like a savings account.
So it's like having insurance and a savings plan, all in one.
Exactly. But that permanence and that added feature, it comes with a higher price tag. Whole life premiums are generally more expensive than term insurance.
Yeah, that makes sense. You're paying for that lifelong coverage and the cash value component. What about those other terms I've heard, like limited payment life and endowment insurance?
Ah, good catch. Those are variations on whole life insurance. With limited payment life, you pay premiums for a set period, like 20 or 30 years. And then your coverage continues for life, no more payments. This leads to faster cash value growth than a traditional whole life policy. But the premiums are still higher than term insurance.
So it's like you're front-loading your payments to get that lifelong coverage faster. What about endowment insurance?
Endowment insurance is, well, it's a bit different. It's designed to mature after a specific period, like 20 years. And then it provides a lump sum payment at maturity. It's often used for specific goals, like retirement planning or funding a child's education.
So it's like a hybrid, kind of,
Yeah.
between insurance and a savings plan,
Yeah.
with a guaranteed payout at the end. Okay, I think I'm starting to get the hang of whole life and its variations, but what about term insurance?
Term insurance is much simpler. It provides temporary coverage for a specific term, like 10, 20, or 30 years. If you die within that term, your beneficiaries get the death benefit. But if you outlive the term, the policy just expires.
So it's like renting coverage for a set period. Why would someone choose term insurance over a whole life?
Well, the biggest advantage is affordability. Term insurance is temporary, so the premiums are usually much lower. It's a good option for people who need coverage for a specific time, like while their children are young or they have a mortgage to pay off.
Yeah, that makes sense. You're only paying for coverage when you really need it. But the manual, it mentions different types of term insurance too, right?
You're right. There's level term, increasing term, and decreasing term insurance.
Okay, I'm all ears. Break it down for me.
Level term is the most common type. Your coverage amount stays the same throughout the entire term.
So if I choose, say, a 20-year level term policy with a $500,000 death benefit, my beneficiaries would get that same amount if I died at any point during those 20 years.
Exactly. Now, increasing term insurance, that's a bit different. The coverage, it gradually increases over time.
Why would someone choose increasing term insurance?
It's often used for situations where, your needs might grow, like with a mortgage, for example. As your mortgage balance increases, so does your insurance coverage. So your family can always pay off the loan no matter what.
That's pretty clever. What about decreasing term insurance?
Decreasing term does the opposite. The coverage gradually decreases over the term. It's often used to, mirror a declining need, like income replacement, as your children get older and more independent.
So you're essentially adjusting the coverage to match your family's changing needs over time. I'm starting to see how much thought goes into choosing the right policy.
It's not a one-size-fits-all situation. It's about finding the right fit for your specific circumstances and goals. And you know what? There's even more you can do to customize your policy with something called riders.
Riders? That sounds interesting. What are those?
Think of riders as like add-ons or power-ups. For your basic life insurance policy, they let you expand your coverage for very specific situations, usually for a small additional premium.
So you can personalize your policy even further to meet your own needs. That's pretty cool. Tell me more about these riders. What kind of options are there?
Well, the manual highlights a few that I think you'll find interesting. One is the accidental death and dismemberment rider, often called AD&D.
Okay, what does that one do?
It provides an extra payout on top of your basic death benefit. If your death, is the result of an accident, it's like an extra layer of financial protection for your family in case of a tragedy.
That makes sense. Accidents can happen out of nowhere, and it's good to know there's additional coverage to help your family through those tough times. What other riders are there?
Another important one is the disability waiver of premium rider. This one waives your premium payments. If you become disabled and can't work, it makes sure your life insurance coverage continues, even if you lose your income.
That's really helpful. You wouldn't want your coverage to lapse just when you need it the most. Any other intriguing riders in the manual?
There's one that's especially relevant for parents with young children, the parental death and disability rider.
That sounds important. What does it cover?
It covers the premium payments on your child's life insurance policy. If you, the parent, die or become disabled, it's a way to make sure your child's policy stays active and their future is protected no matter what.
That's incredibly thoughtful. It's like a safety net within a safety net. Are there any other riders worth mentioning?
Yeah, well, one more I think is worth highlighting. It's the guaranteed insurability rider.
Okay, tell me about that one. What does guaranteed insurability even mean?
This rider gives you the option to buy more life insurance in the future at certain ages or life events without having to go through another medical exam. It's a great way to, make sure you can increase your coverage as your needs change, like if you get married, have kids, buy a bigger house.
So it's like locking in your insurability for the future. Regardless of your health, that's a great option to have.
Exactly. It provides flexibility, peace of mind. As your life evolves,
wow, these riders add a whole other dimension to life insurance. I'm starting to see how personalized these policies can be to fit different needs and situations.
You're absolutely right. It's not a one-size-fits-all situation. But before we get too focused on individual policies, let's zoom out a bit and talk about something called group insurance. The manual says this type of coverage is issued to a group of people under a single master policy.
Group insurance, I think I've heard that. Isn't that something employers offer?
You got it. Group insurance is most commonly offered through employers or associations like professional organizations.
Okay, so how does it work?
Well, instead of individual policies, one policy covers the whole group. This usually means lower costs for everyone.
That makes sense. It's like buying in bulk, right? Are there any other advantages to group insurance?
One big one is you usually don't need to prove your insurability. This means even people with, health conditions who might not qualify for an individual policy, they can still get coverage through a group plan.
That's a huge benefit for people who might otherwise have trouble getting insured. Are there any downsides to group insurance?
Well, one thing to keep in mind is that the coverage might be more basic than what you could get with an individual policy. And if you leave the group, like if you change jobs, your coverage usually ends.
But the manual mentioned something about converting to an individual policy, right?
You're right. Most group policies have a conversion option. That lets you switch to an individual policy when you leave the group without having to go through another medical exam, so you can keep your coverage.
That's a great safety net. So group insurance can be a good starting point or a convenient way to access affordable coverage. but you might need to consider an individual policy later for more comprehensive or long-term protection.
Yeah, exactly. And speaking of long-term planning, there's one more product mentioned in the manual that I think you'll find interesting. Annuities.
Annuities, okay, I've definitely heard that term before, but I'm not really sure what it means. Is it like another type of insurance?
It's a bit different, but it's still offered by insurance companies. Think of an annuity as a way to, create a steady stream of income, typically for retirement.
Okay, so it's not about providing a death benefit, like life insurance, but more about generating income for yourself while you're alive.
Precisely. You pay a lump sum or make regular payments to the insurance company. And in return, they guarantee to pay you a stream of income for a certain period or even for the rest of your life.
That sounds like a helpful tool for retirement planning.
It can be. And there are different types of annuities depending on, when those income payments begin, immediate or deferred, and how long they continue, like straight life, annuity certain, or joint and survivorship.
Wow, this is a lot to take in. We've covered so much today. Risk assessment, different types of life insurance policies, those cool riders, group insurance, and now annuities. It's amazing how this training manual has, demystified insurance.
It really has been a crash course in insurance essentials.
But before we wrap up, I'm curious, are there any, ethical considerations when it comes to insurance? When buying or selling it, I mean.
That's an important question. Yeah, it's definitely something to think about. With something as important as financial security, there can be some gray areas.
Right, it feels like there could be, especially with all these different products and options.
Exactly. For example, the manual, it actually warns against something called rebating.
Rebating, what's that?
So rebating is when an insurance agent, they offer to give you back part of their commission as an incentive to buy a policy from them.
Sounds a little, a little shady maybe. Why is that a bad thing?
Well, it can create a conflict of interest. The agent might be more focused on making the sale, getting their commission, rather than actually finding the best policy for you.
So it's important to make sure you're working with an agent who's genuinely looking out for you, not just trying to make a quick buck.
Exactly. And it's not just rebating. The manual also mentions other practices to watch out for, like twisting, for example.
Okay, twisting. That sounds kind of ominous. What does that involve?
Twisting is basically when an agent, they misrepresent a policy or make false statements to convince someone to switch from their current policy to a new one.
So it's like a bait and switch tactic, but with insurance.
Exactly. And it often leaves the policyholder worse off, They might end up with a policy that doesn't meet their needs or one that costs them more money.
It sounds like it's really important to do your research and carefully compare policies before making any decisions.
Absolutely. Don't be afraid to ask questions. Get clarification on anything you're not sure about. A good insurance agent, they should be happy to explain everything clearly and transparently. The manual also mentions defamation and replacement as unethical practices.
Defamation, like spreading rumors. And what's replacement?
Yeah, so defamation in insurance, it's making false or damaging statements about a competitor just to, steer business your way. And replacement is when an agent encourages someone to replace their existing policy with a new one. That might not be in their best interests, often just to generate a new commission for themselves.
So basically, all of these are situations where the agent is putting their own profits ahead of the client's well-being.
Exactly. These practices are not only unethical, but they can really hurt the policyholder. It's a good reminder that integrity and transparency are super important in this industry. You want to work with someone you can trust to give you honest advice and guidance.
That's so important. It's about building that relationship based on trust, knowing that your agent is really working for you.
Absolutely. It's about finding an advocate, someone who will help you navigate this whole complex world of insurance and make informed decisions that, align with your goals.
Well, I think we've officially conquered the Jamaican long-term insurance landscape. This training manual has been so helpful, taking us from the basics of risk all the way to, ethical considerations and those potential pitfalls to avoid.
We've covered a lot of ground, that's for sure. Different types of life insurance, those customizable riders, group insurance, even annuities.
It feels like we just finished Insurance 101, but in a way more engaging way.
Exactly. So now that you have this knowledge, what questions do you have about your own financial planning? How does insurance fit into all of that?
That's the perfect takeaway for our listeners today. This deep dive, it's giving you the foundation, but the real work is applying this knowledge to your own situation. Take some time to think about your financial goals. your family's needs, and explore the different options out there.
Remember, knowledge is power, especially with finances.
So true. And who knows, maybe this deep dive has sparked some new questions or areas you'd like to explore further. We're always here to help you navigate this world and make sense of it all.
Until next time, happy planning.